In this week's market update, all eyes are on the Fed as the US central bank prepares for the first rate cut since the financial crisis. UK shares rise as the pound falls, and there's a flood of results announcements as earnings season picks up speed. US interest rates are almost certain to be cut this week. The only real question is whether the Fed will opt for a quarter or half-point reduction in the cost of borrowing. The announcement on Wednesday evening, UK time, will mark a watershed for America's central bank. It will be the first cut in US interest rates since 2007, when the Fed moved to counter the unfolding financial crisis. It took rates from 5.25% to just above zero in a year, and they remained at that level until the Fed led the world in normalising monetary policy in 2015. Now it looks as if the Fed will start easing again, despite rates having got no higher than 2.25% to 2.5% over the past 4 years. If rates really have peaked, then they have done so at a much lower level than in previous tightening cycles. Although it looks like rates are due to start falling this week, there is some dispute about whether a cut is really needed, with the jobs market remaining strong and the stock market at near record levels. The argument for cutting rates is that global economic activity is slowing on the back of heightened geopolitical tensions and Donald Trump's trade war with China. The Fed has used precautionary rate cuts in the past to prevent recession. This was notably in the late 1990s, when 2 sets of rate cuts extended the economic cycle until the dot-com bubble burst in the year 2000. But recent economic data have suggested the economy might be stronger than the Fed fears. Retail sales and job creation numbers have been better than expected. Last week it emerged that the US economy grew at 2.1% in the second quarter, a bit faster than forecast. That suggests that the Fed will settle for a quarter-point cut this week. The day after the Fed's announcement, the Bank of England is also due to review interest rates. Here, there is little expectation of a move, as the UK central bank waits to see which way Brexit goes under Britain's new government. Interest rates failed to follow the US higher during the 3 years of uncertainty that followed the EU referendum, and now the bank finds itself in a bind. Rates are too low to cut much if there's a disorderly Brexit, and will be hard to raise to counter any rise in inflation because of the high level of uncertainty in the economy. The impact of the week's central bank decisions on the markets is hard to predict. Usually falling rates are good for stock markets because they reduce the cost of borrowing for both businesses and individuals. Sometimes, however, investors focus more on the reasons for the rate cut than the reduction itself. If investors start to worry about a slowing economy, the Fed's move might actually be bad for the level of the stock market. It is certainly the case that the best performers in the US market over the past year have been the most defensive sectors, such as utilities and consumer staples. These are areas of the market that attract investors when the outlook for profits and income is uncertain. The preference for defensive shares suggests little confidence that recent highs will hold. The US market is on course for its best year in decades, with shares up 20% year to date. But if you go back a full year to a point before last year's fourth quarter market slump, the appeal of defensive shares is clear to see. They fell less last year, but have enjoyed the rallies so far in 2019. As a consequence, they have enjoyed double-digit gains over 1 year, compared with just 6% since last July for the S&P 500 index. Similarly, the reaction of the currency market is not completely predictable. Lower US rates usually imply a weaker currency, as the income from holding dollars reduces and other currencies become relatively attractive. In times of stress, however, the dollar can sometimes act as a safe haven for nervous investors, so lower rates might counterintuitively lead to a rise in the US currency. Currencies are certainly the main focus on this side of the Atlantic this week, as the markets start to worry about the prospect of a no-deal Brexit at the end of October. The odds on this kind of potentially disorderly departure from the EU have risen since Boris Johnson became Britain's Prime Minister last week. Johnson has said that the UK will leave the EU at Halloween, come what may, and preparations for no deal has stepped up in recent days. The pound, which is usually the lightning rod for Brexit fears, has fallen to a 2-year low of just above $1.22. That makes overseas holidays even more expensive and will be unwelcome as most UK schools begin their summer break. Investors in UK shares tend to be more relaxed about a fall in the pound because many big UK companies earn a high proportion of their profits overseas. A weak pound makes exports more competitive, while overseas earnings are worth more on translation back into sterling. That means the lower pound is often accompanied by a rise in the FTSE 100. That was certainly the case yesterday, as the UK's blue chip index added 1.8% against an otherwise difficult backdrop for global equities. Most markets outside the UK were more concerned with the resumption of trade talks between the US and China and were waiting nervously for the Fed's announcement on Wednesday. UK investors also have plenty to focus on this week as some key company results are due. The spotlight will shine on banks, with numbers expected from Lloyds, Barclays and RBS. Commercial property, especially those invested in the struggling retail sector, will get a moment in the sun with results from Hammerson and Into Properties. Also in focus this week will be Centrica's dividend. The British gas owner has long headed up the dividend yield table with an implausibly high income that suggested investors are waiting for a dividend cut. BT, another former dividend favourite, will be setting out its stall after warning it is considering cutting its payout to fund expansion of its fibre broadband network. Looking east to markets in Asia, Hong Kong is grabbing most of the headlines as the former colony's benchmark index tumbled yesterday following more mass demonstrations and violent clashes over the weekend. Protests about a proposed extradition treaty with China have escalated as protesters have clashed with rival groups thought to be linked to organisation crime groups. Property stocks were hard hit as the Hang Seng Index fell by more than 1%. That reflects concerns about the attractiveness of the city-state as a business hub if China's presence becomes ever more intrusive. When Britain handed Hong Kong over to Beijing in 1997, it was on the basis that China would allow a one-country, two-systems regime for 50 years. Hong Kong would become part of China, but would benefit from an independent legal system and press freedoms. However, recent events have cast doubt over that belief, and many residents are questioning what the future holds.